Hi all, I am Sham and I have Kishan with me.
Hi, hi, Sham.
Welcome to Free Float. Today we are going to be discussing behavioral biases. I'm sure most of you would have heard about how we all suck at making decisions. So today we're going to have a slightly different view on why that may not be entirely true, at least when it comes to decision making in in the area of investment management and maybe managing your own investments. We'll start with Kishan giving us an introduction of what these behavioral biases are, and then I'll probably chime in with why the economists studying this maybe getting sidetracked with the with the bad model. So anyway, Kishan, do you want to take it away?
Yeah, sure. So, so Sham, I think I mean, in the last few years, we both have probably read many books, many articles about like I mean like behavioral finance, about like cognitive biases and stuff,
Right.
like like Thinking Fast and Slow, which was
Yeah.
a really hard book to read. I mean, it was. I mean, I had to literally, take a pencil and like explain myself what he's trying to say. Try to make me understand, because and then you had this like this explosion of interest in this field because of those books and just generally people talking about it. It so happened that people, I remember reading an article about somebody trying to explain a guy in a bar that about some cognitive bias he had the way he ordered a drink, and the comment was that a man cannot go even to a bar anymore without being attacked for his cognitive biases. which I thought peak peak this hysteria
I
about
mean, it's kind of look, you kind of hit the nail on the head, right? Like, why the hell do you go to a bar in the first place? And if you're going there and you're chewing somebody's head off with this nonsense, then that itself is a behavioral bias.
yeah. I mean, and and the thing is that there are probably some tour biases that if you go just to the Wikipedia page, there are like 200 biases that you can see, and at the end you'll be like, oh my god, there's so many, and there's so many things that I think I am infected by, and 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 I think you know it started off with with just research, right? I mean, people just I mean, just people wanting to research and to understand how people behave with finance and with money, and or even just generally what bias people have. That's a that's the function of, I think, any good social science, that people, that that's how you need to study things like like this and understand people better, and that's a function of it. But I think people try to take this and then apply it to their own lives, you know and then it become like a prescription, like no one told them to, I mean, it's more like 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 when someone talks about behavioral finance, like like any of the like the economists, they're not telling you you should change yourself, like, or you should change, or you should be. They're just saying that we are researchers and we want you to be aware of it. I think that point gets lost, and then
And I
people try
think
to apply.
there was another study, right? So which said that it's very hard to change yourself anyways, right? You're going to do whatever you want to do. But knowing about this behavioral biases, like say you went and read Thinking Fast and Slow and 5 other books on behavioral biases, it gives you a false confidence that you're now without those biases.
Yes.
Did you read that? So it's basically like, now that I know that all the things that I could be biased against, I think that, I'm not biased against it anymore. But in fact, you are. And, it gives you that you only get this false confidence that you're free of bias and while you're not truly free of it.
Yeah. Yeah. And that I understand. I mean, that I understand from a very from a very rational point of view, right? I mean, in the sense that it's good to be aware, and it's sometimes when you're making a decision, like I always tell this thing of sunk cost fallacy. Like like when someone tells me like something about oh, why are you wasting that, it's something, and I'll say I there's a thing called sunk cost fallacy, right? And I use that to justify everything.
Yeah,
Yeah,
I think that, my favorite thing is, that sunk cost fallacy and the endowment effect. So it basically means that, you just need to, sit in a room by yourself and meditate, right?
yes.
So, that's the only way you can overcome sunk cost fallacy and the endowment effect. Come on, like, if somebody gives you, if you have a candy, in hand, you want to eat it, right? You don't want to like do one scientific experiment, with that, with that.
Yeah, yeah. And the thing about this I mean, what also happened is I think a lot of companies and stuff try to use it to their advantage. So a lot of I think companies use behavioral economics or or behavioral science to like if you have a product that needs to be subscribed to. A lot of companies use behavioral science to to increase the number of subscriptions they have. So it's not just on the time or or when to hit people, but how to appeal to those biases to increase their subscription. I know like Adobe has a good team like that specializes in this
Right.
in this effort. So yeah, many people take advantage of of this knowledge, and unfortunately also like for example, like today what we're talking about which is loss aversion bias. um, like what does loss aversion bias say? That people would rather uh, would rather um, I mean the cost of or the pain of of taking a loss is much more than the pain of them getting a win. That's a very I mean there are people who are like that, and they're normally the people who you think are the more responsible kind.
Right. Right.
I mean the conservative, they would rather have a very defensive approach, to the way they lead their lives, and they're looking. It's like it's a Dravid, right? I mean, who will guard his wicket till for a long time. It might be very painful to watch, or not fun to watch, compared to someone like Sehwag, you know. But but you think of that as responsible, as responsible behavior, because sometimes if you are playing uh, like too rashly or too thing, the chance of you making a mistake is also much more, and and the fact is, before you make a decision, you don't know what the probabilities of what the actual probabilities are. It is all a blur.
Right. So here's my thing, right? So look, when it comes to investing, what people only focus on positive compounding, right? So there's so many WhatsApp messages floating about, 1 + 0.1 to the power of 99 will give you like blah. So this is like the power of compounding. So even if you compound 5%, over 20 years,
Yeah.
you're going to be a billionaire or whatever. So so the problem is that compounding works both ways, right? So instead of that +5%, if you compound -1% over 20 years, then it'll asymptote to zero, right? So the problem is that this sort of guarded approach to investing is probably a rational response to fat tails, right?
Right.
So it's one of the charts that we posted in the article, which is you can have years of average compounding wiped out by a month of negative results. So when you have these kind of fat-tailed events, in finance, in the markets, right?
Right.
So it is very difficult to, say that this guarded approach is not rational, right?
Right.
It feels like it's entirely rational to me. Like if you have the ability to sort of be extremely risk averse when it comes to fat tails, it makes sense from a long time compounding point of view. And if you use the same model that these behavioral economists have used to judge this investor's behavior, it'll label him as irrational, right?
Right.
Oh, he is so loss averse, and he's not and risk seeking on the other side. But it is true though, right? So you need to be risk seeking when the odds are in your favor. Now, a couple of years ago, I remember a prominent investor saying, if I had to bet on returns for the next 5 years, I would probably go and invest in Russia, right? So do you know who that was? So
No, I mean, yeah,
okay,
but I mean,
like 2 years ago, right? Think about where Russia was. There were
yeah,
like sanctions over sanctions, right? So, and theirs is a very commodity heavy country.
yeah,
So, oil prices were, kind of headed down. There was really no um,
justification.
yeah, justification for it. But he was saying that, look, these are all mining companies. They're all mining nickel and aluminum and all those things, and they're selling at some two times book, or some ridiculous stuff. It's like
Right.
it was dirt cheap, right? So he was like, if I had to bet on this, they have a new finance minister who's at least focused on making sure that part of the equation is stable. So irrespective of what Putin does, things are cheap. So from an expected return point of view, if you truly care about value, you would go and invest in Russia. But you can go either ways with that, right? So you have
Right.
huge political risk. There is, Putin doesn't like, play nice with anybody. So we don't know what the hell is going to happen. 6 months from now, maybe he'll jail all the oligarchs. Who knows? But his thing was all those things are priced in, right? So it's priced into that into the valuation. So you should be buying Russian stocks, and this should get you thinking, right? So when you swing your bat, right, you need to swing it hard when the opportunity arises, and and calling that irrational is wrong, because sometimes things are so bad that the only way it can go is up, right? So you need to have that cash. So you can be conservative all you want, when things are sort of bullish, or kind of in the medium horizon, but a medium sort of existence. But when things get really dark and negative, uh, there are investors who will switch from being conservative to being super aggressive, and go for the kill at that time. So it's impossible to say that the same investor will behave based on this particular model all the time, right? So based on the situation and the probabilities that he's attaching to eventual outcomes, his behavior might change. So once again, this whole behavioral model doesn't take that into account.
Right. Yeah, and I understand that, like, I mean, what you're saying is that, uh, for when you see an opportunity and stuff, people have to, if you have the ability to invest, you should take, like hard shot. The problem becomes, you know, um, like everyone wants, like, like we mentioned, like everyone wants more money, right? But at the same time, um, if say somebody in Bangalore, who was working in a software company, and and had a fixed income, a fixed amount of income every month, and he had to save, and he's going and investing in Russia, taking that risk. it might not be the appropriate thing for him to do, because it's very risky. For all the risks that you mentioned, and in that case, if he's, maybe Russia is the best investment out there. We don't know that, right? But say someone makes a good case, right, that Russia is the best investment and stuff, and say for someone who needs a regular stream of income, should not be exposed to a high volatility, especially in a market where there are many more uncertainties. Investing itself is risky, but investing in Russia, totally unknown, this thing is going beyond your risk profile, and then you make a decision like that, then you're basically putting a lot of things that you value at risk, because if you make a if it whether it turns out or right or wrong, that's a different thing, but you doing that itself is wrong, uh, because you're not thinking about the various like the various um uh, importance that the various things that are important to you, with that money, instead of trying for you to make a lot of money, and in the chance of losing all that money, you need the money for your life, right? And this is the other thing that I have, like, home bias, like, in markets you talk about home bias, like I always felt, like, we all read about US stocks, we might know a bit about what US companies are, but for example, in India, I know what is Sun TV and Z TV, right? I know it from a very intuitive sense, that I know what I know, the political angles. I know, the background of promoters. I know how business works in India, and especially broadcast media. I understand it from a more intricate point of view. That understanding I wouldn't have of, say, any equivalent in the US. I might know a lot about Disney, a lot about things, but my understanding of that is not. And I might watch even more Disney movies, but for me, I understand more how the business of broadcasting, of TV works in India, because and that I mean, for someone, and that same advantage I don't have in, when I'm investing in US or something, because there's something I just don't understand. You can't understand everything by just reading, right? There's some things, that are unsaid, but it's there underlying, uh, and that is something I think, only, people have this own bias, because investing in a foreign market is foreign to them.
Right.
It's
So,
yeah.
so I got into trouble, when I pointed this out a couple of years ago. So there's this fund, I obviously don't want to name it, but they have like a fairly decent chunk in actively managed U.S. equities, right? So they actively manage U.S. equities in that, in that particular fund, sitting in India. So I was like, look, if you just swap that out for, an equal weight, Nasdaq and S&P 500 index fund, are you honestly saying that you can beat that sitting in India, right? Because in the US itself, there are hundreds of sell side analysts, thousands of buy side analysts. They're all looking at these stocks. They're going on management calls. They have access to the management. Some of them may be playing golf with them, and you're saying that sitting in India, you can actually beat, a combination of S&P 500 and QQQ, by actively managing that bucket. And I said, I'm not going to invest in your fund, unless you kind of break out, how your actively managed US part, just break it out into a separate, kind of portfolio, and benchmark it against these two indices. And they were kind of pissed off, because they were like, you should look at it from a holistic point of view. The whole portfolio kind of makes sense, India and US. Like, okay, if I want to do this, I'll just buy, Nifty 500 and S&P 500 in some sort of combination, be done with it. So I'm not going to, pay you to sit in India and manage, US stocks without having access to management, because, that seemed like a very, very sort of dicey proposition to me. And it is true, that home bias, is basically a, information availability bias, right? So you have a lot of information about stuff around you. In fact, one of my favorite things to do is track down listed companies with, with most of their operations in and around Bangalore, right? So what this allows me to do is actually go and check that out. Like I can actually go and tell them, look, I'm an investor. Can I,
Yeah, yeah,
can I talk to someone here? So not that it's a great value add, but it feels
yeah,
like, okay, there's an office. There are people working there, so it's not like some shed out in the Midwest, and I'm buying
yeah,
something,
yeah.
so.
Yeah, yeah. One of my other favorite biases that always gives me a thought is commitment bias. So say you like like say you make so it means that if you're committed like to something, right, like to some idea or some thought or something in life, and you say I'm committed to this, and you'll continue to be, I mean, to pursue it, because you feel that you're committed to it, and stuff like that. And I mean, there's some truth to it that sometimes you might be too involved, too committed and stuff. But human endeavor is, I mean, all human relationships, or uh, uh, or all human interactions, or human endeavors requires commitment. I mean, to be so committed, to be that you're so irrational that that it produces, because like if you tell someone that I gave you my word, and then you tell, no, I did give you my word, and then he asks you why, because I was guarding his commitment bias. uh, you know uh, you will probably have no friends left.
So there are a lot of things like this.
Yeah,
So
yeah,
and in sort of like typical Wall Street swagger speak, right? If you're so smart, how come you're not rich, right? So I think somebody asked that to those behavioral scientists, and one of them actually set up a couple of funds. So that idea behind those funds is that he'll capitalize on other people's behavioral mistakes, because he is obviously has a PhD, and
yeah,
he's like the inventor of this whole behavioral
yeah,
field. So
yeah,
obviously he's got the inside track and the inside edge and the
yeah,
latest cutting edge
yeah,
research, and he is
yeah,
so so he invests in like small caps in the US. And you just been if you are even considering investing in small caps, you would have been better off just investing in the market weighted ETF from BlackRock, instead of doing all this PhD level analysis to buy stocks. So yeah, I mean, these things are tricky, right? Because what I feel is, once again, an economic model, a model which is suitable for writing papers in economics, is not suited for in the for being applied in the investment landscape at all. Those models are themselves flawed, right? They are flawed in the sense, even this behavioral economic model, even with all the adjustments and everything, that itself it's kind of like putting band-aid on a flawed model. Rather than looking at how people perceive risk in the real world. And once you see why they perceive risk that way, right? I gave you an example of and geometric compounding. So if a fact tail comes and you're down 50%, it takes 100% return from there to actually come back to break even, right?
yeah,
So it is natural. It's actually logical to be risk averse, in these sort of situations. It is not unnatural. And by calling it a bias, you're just making a fool of yourself because you're doing arithmetic compounding. It's not, you cannot run these experiments, side by side and sum it up and say, okay, here's the average. That is not what that's not how the investing world behaves, right? So these events come serially and you need to apply geometric compounding. So and most of the time, I wouldn't say more, 100% of the time you have only one life, right? So you have to make your choice upfront, right, and live with those consequences later. So I'm not like, I can't spawn 100 different versions of myself in a multiverse and allow 100 different experiments to occur and somehow magically come together at the end of at the end of the experiment and then get an average of all my 100 different paths that I've taken, right? We don't do that. We have only one life, and we have to go down a path that we choose, at day zero. And this is something that this model doesn't capture.
Correct.
um, and that's my pet peeve, which is all we have all these people saying, oh, you have this bias, that bias, which where it all applies to when I buy candy or when I buy some small ticket stuff. Then maybe I applying these models might help me. But when it comes to big life decisions like investing, and there's so many decisions that we make up, basically you only make them once or twice in your life,
Yeah.
right? So in those situations, these things are completely useless. And sometimes it might prevent you from really swinging for the fences and and seeing what happens, because they don't take into take fat tails into the equation at all. And remember, fat tails works both ways, right? So you have both the left and the right. So so how do you get this this advantage where you're kind of skewed to the right, kind of exposed to the right fat tails and not the left ones. So those are the things that, if you're too focused on the theory of this behavioral investing and all that stuff, it blinds you to the opportunities that that life provides. So that's kind of like my personal experience as well. Uh, so, and I think you kind of hit the nail on the head when you gave this example, right? So, I may have a decent chance of being able to pay for a vacation next year, but should I really risk my house for it, right? Behavioral scientists will say you're irrational. Both of them should be the same, but it is not, right? I attach different utilities. I attach different importance to both those assets. So so these models are are great. If you want to publish some papers in economics journals, I think that partially explains why there are so many behavioral quirks that have been listed. It's kind of like you get into university and you write a paper on that. But I frankly don't see how an investor can benefit from following it. In fact,
Yeah.
you need to basically know some simple probabilities, and you'll be fine. You don't need this kind of theory, and that has been proven from their own track record, right? So with all these PhDs and all this research firepower behind them, they themselves haven't been able to generate alpha. Forget alpha, they haven't even been able to beat a simple ETF. So this whole thing is highly suspect, and you're better off just saying, you know what, I know all these things exist, but so what?
Yeah, I mean that's what like a wise person would say.
All right, guys, thank you for tuning in, and we'll keep hammering away at different things, down the line. So stay tuned to Free Float, and we'll catch you next week.